What's going on, everybody? Welcome back to the channel. I appreciate you stopping by, spending a few minutes of your time here with me tonight. Tonight, I've put together a few slides that we're going to go over. And if we have time, we will look at a few charts from last week or whatever. But all of this is sort of foundational, basic stuff to better understand Stacy's system. Okay, we're not necessarily going to go over day counts and stuff like that. We're going to go over structural templates. Okay, and I want to reiterate this: these are structural templates. We could, you know, talk about entries and get real precise and stuff like that, but the thing is, this is really more about sort of like the profile of the market, more of like the template of what is happening. Okay, the general structure. That's how I want you to think. I don't want you to think, candle by candle, because you're going to get confused there. Instead, use the overall template. All right. And even when it comes down to your entries and stuff like that, you just want to be thinking more in this profile type of mindset where you're seeing the pattern more than you're seeing the details, right? You're zoomed out a little bit on the overall structure that you're seeing on the chart to understand, if you're shorting, you're going to enter, or where would be a decent place to enter. You get what I'm saying? So this is where we're going to start off, right? If we suspect a lower close on the day, we want to buy high, preferably anywhere at or above the previous day's closing price. Okay, this is the ideal scenario, but it won't always work out that way. But generally speaking, what we want to see is this market pump up into the previous day's high and low range before failing and giving the lower close. Okay? When we look at a daily chart and we see a series of lower closes, those candles will have wicks on the top of those candles, and those wicks represent a portion of intraday price action that took place above the previous day's close or the current day's open. And that's where we want our entries, okay? You have to think about it logically. If we are expecting this market to ultimately close lower than it opened by the time the market closes, right? Then if we can get in this market above the previous day's closing price, we are getting it at a good price. It doesn't matter where you get in above that closing price. If it gives a lower close, you will be in the money by the time the market closes, okay? Here's just another example showing you this. All of this price action above the closing price, that becomes the wick on that daily candle, right? And if we can get in the market somewhere in that wick, right, that is pushing back up into the previous day's high and low range, we are getting in at a good price if we are selling, because when we get the lower close, all right, we're going to be well into the money. If we suspect a higher close on the day, we want to buy low, ideally at or below the previous day's closing price, which would be considered a discount price, whereas something like this is a premium price, okay? And it's premium because it's high, it's discount because it's low, all right? This is like if you went to the supermarket, last week on Friday, and you saw that peanut butter was $8 a jar, and then you came back next Tuesday and peanut butter was down to $3 a jar, you would be like, wow, that's a discounted price, okay? And it's just that simple. This portion of price action that's taking place below the closing price ultimately becomes that bottom wick on the daily candle. And this is the area where we will find our most ideal entries. If price is going to give a higher close than the open, if we can buy anywhere below the opening price or the previous day's closing price, we're getting a good price. Now, here's just an example. These would be daily charts, daily candles. 3 days with higher closes. These candles are going to have wicks on both sides 99% of the time. All right. And these are just examples. This is just how the market works, right? It's going to dip down below that closing price and then go up above closing price, dip back down, break out, pull back, break out. Okay. It's the same thing. We break out, pull back, break out, pull back. This is just how the market moves. And anywhere in this area that we could buy would be a great place to buy. All right. It's just simple. It's just simple. The more simple we can create this in our mind, the easier it's going to be for us to execute when we come to the charts. All right. And here is just a sort of a weekly template of a higher time frame dump and pump sort of week, all right, with smaller examples just to show you it might look different, different weeks, all right. But a lot of the times we'll have something like this where we have, our day one, day two giving lower closes, and then an inside day, okay, which is like a halt of the momentum. The market's been moving lower, and then suddenly those sellers run out of that momentum. We get this inside day, just a coil there near the bottom of the week, right? On top of the low of the week, right? We just go sideways. And then we might get our, false break of that inside day the next day, a first green day on Thursday for an explosive parabolic move on Friday. Here's the same deal, but a pump and dump instead. All right, we might have Monday, Tuesday that trades higher. Wednesday breaks Tuesday's high before breaking down and giving us our first red day close. All right. Then a London opportunity. This market could pump all the way back up here, breaking out of Thursday's high back into Wednesday's high before the market rolls over. Right. Here's the start of that pump, the pump and dump. All right. Here's a different way it could play out. And here you can see how we are playing above the previous closing price, the previous closing price of last week, right? And so all of this price action, and this happens more than you would think it does, where we do this whole song and dance, right? Just to close relatively equal to the last week or just a little bit lower or something like this. All of this price action up here would be the wick on that weekly candle, right? But you can see here's the previous week's high. We break out of that level on Tuesday, all right? Inside day on Wednesday. And then you can see we have all these equal highs here on Wednesday and Thursday for that first red day sort of thing. Friday is going to pull back perhaps right back to that level before melting down to close the week, right? Here's an example of a continuation type of trade, right? Where on the day this market breaks out of the previous day's high, right? And instead of just failing and reversing, all right, because I'm always talking about reversal trades and showing mainly reversal trades on my channel because that's what I like to trade. But these continuation trades, they could be your go-to setup, you know what I mean? So we could break out of the high of the day. This market could pull back to the high of the day before giving you that trade in the session that you're trading. Now, it may not always happen. That really does not matter to us because we are waiting, right, for the market to do certain things before we get in. So even if this doesn't happen on Monday, it doesn't happen on Tuesday, it doesn't happen on Wednesday, it may happen on Thursday, and that's when you're going to trade. And who cares about the rest of those days, okay? Here's an example of a market that is trending lower, right? So we could break out of this market early in the day in Asia, continue to go lower through the London session and pump back up going into the New York Open before ultimately failing and continuing that downward momentum. Here's an example of some reversals, all right? This market is pumping up. We barely break out in London, okay? Then pull back and then heading into the New York session, We break out again, putting in a new high of the day level. And you can see this sort of head and shoulders, this triple top kind of formation, all right, before we break down in the session. We could have something like this where we break out in the gap time between Tokyo and London. And then again, London is pulling back into that low of the day before going higher for something like this in New York. All right. Or we could have something like this where we have our Tokyo session, our London session coiling on top of that level, and then we break out right before the New York session. We dump down right before the session opens and then start going higher for the reversal. All right. Here is an example of the master pattern template. All right. Now, the master pattern is used as a template and a visual aid to help us identify shifts in the market from front side to the back side of a move. All right. In this main example here, we're talking a downtrend in the beginning of the day, okay? A downtrend consists of strong highs and weak lows, meaning that the highs on the way down are not broken, but the lows are broken as we continue to put in lower lows. Our peak formation high begins this micro downtrend on the day, okay? The peak formation low down here signifies a potential area where price may shift from bearish to bullish. In order to have that peak formation low, be locked in place or to be a peak formation low, price has to begin trading in the other direction, okay? Kind of locking in that peak formation low, all right? But what we really want to see is a higher high on the inside, all right? This is showcasing a structural change in the market because remember, we have these strong highs. None of these highs should be broken as we continue this downward momentum. But when we do have one of these higher highs broken, it could be telling us the market is shifting direction, all right? And now, instead of going lower, wants to go higher. Here's an example of the master pattern that takes place over the course of 3 days. All right, we may have our peak formation low on day one, and this could be a Monday. It could be any day of the week, all right? This could be a Friday, Monday, Tuesday, all right? But we would have our peak formation low on day one, peak formation high on day two, and then we put in this lower low on the inside. You can see this market breaks down, breaks the current low of the day, all right, putting in a lower low, and then the market pumps up into the New York session before rolling over and giving ultimately a lower close on the day, right? A pump, coil, dump type of trade, right? Now let's look at some charts. This is a dump and pump template from the DJ30, all right? This may have been, this was not last week, but the week before, right? So you can see the same sort of deal that we just went over in some of those slides. We have a Monday that gives a lower close, a Tuesday that gives a lower close, all right? And on that way down, we're getting pump and dump type of trades. And then on Wednesday, this market goes a little bit lower, breaking out of Tuesday's low before ultimately catapulting to the upside and giving us a first green day signal day. And then we have a very good first green day follow through type of trade here. And even on this day, you can see that master pattern at play because, again, this may not happen every single day, and that doesn't matter to us, or it shouldn't matter to us. We are sitting back and we're waiting for the market to present us with our ideal setup, and that is when we strike. When we strike, we hit it hard so we make all of our money on these days when it's easy to make money, okay? But here is our master pattern taking place over the course of 3 sessions, all right? We have our peak formation high here in Asia, right? peak formation low down here in London, and then we start putting in higher highs, right? By the time we get to the New York session, we have had, our first higher high, and then that higher high is broken. We have our second higher high, which is trading back into these Tokyo lows, all right? We pull back going into the open of the session into that EMA, coil sideways, and then explode, all right? That's the master pattern on a smaller time frame playing out, right? And then on this larger time frame, here's our peak formation high on Monday, or you could say here on Tuesday, we have a peak formation high, a peak formation low, and then this market starts making higher highs, right, for the dump and pump. I can hear coyotes running through the woods out there. Here we're looking at gold, okay, a similar sort of template to the DJ30, but it is a little different, all right? We have a lower close on Monday, and then we get a higher close, first green day type of day on Tuesday, all right? And then the next day, we don't get that trade in our session, okay? You see, it happens later on where we explode and put in the next bit of higher highs on the day, right? But you can see the master pattern at work here, right? Peak formation high in Tokyo, peak formation low in London/New York, this area. This is our peak formation low. And then this market, if you look closely, this is our higher high on the inside, okay? This market dumps, coils, and then pumps through that EMA. And then again, the master pattern plays out right here perfectly. Peak formation high in Tokyo, peak formation low in between, London and New York. We have our higher high on the inside. We'll take a closer look at that here in a moment before this market explodes. All right. Now, here, I'm just showing you, all right, that this market has started to put in higher highs, right? It was going lower until here. Bam, we get higher highs. We get more higher highs. We get more higher highs, more higher highs. And that is letting us know that we are looking for dump and pump type of trades. If the market is making higher highs, okay, on a consistent basis, if it's trending higher, putting in higher highs, we're looking to enter this market when it pulls back, right? And then explodes to put in the next higher high in the session that you're trading, right? So here's a closer look on the day. You can see we have our higher high on the inside coming out of the London session. Then this market dumps down into the current low of the day, right? We get 1, 2, 3 pushes back into the low of the day level before this market explodes, all right? And a lot of us, we want to enter as soon as we can. People like to enter down here, right? But me, I like to play this safe, bro. I would have waited all the way until we break out of this higher high on the inside. That would confirm it to me that, okay, things are shifting. The market wants to go higher. And you can see right around here, the 10 o'clock hour, this market puts in this higher high, pulls back and coils sideways into that EMA, engulfing here on this chart before trading higher, all right? And you could get in anywhere here, all right? So I hope that this video made sense to you. I hope that you got something from it. Again, this is not supposed to be advanced. It's supposed to be very simple stuff. We're keeping it simple. We're paying attention to the market from a structural point of view rather than a candle by candle basis. You understand? We don't want to be reading the candles. We don't need to read the candles, okay? At least not until we get down to the nitty gritty of things. And even then, we're just keeping it simple, okay? We already know what we're looking for because of the master pattern, right? We already know we're looking for a dump and pump, okay? And so all we have to worry about with candles is looking for those engulfments, those pin hammers, okay? Those micro M's and W's, all right? So I appreciate you all being here with me. Until next time, I hope you continue to free your mind.